Warren Buffett once offered $100,000 for 10% of a student's future earnings. Do that math. He valued an ordinary person at $1 million before they'd done a single thing. The question isn't whether you're worth that. The question is why you've been spending years destroying it. Every individual walking into a room carries a capital value, measurable, compounding, and almost universally mismanaged. The framework for understanding this is not complicated. It is the same discounted cash flow logic Buffett uses to price a business. Applied to a human being, the numbers are staggering. If this way of thinking about yourself is unfamiliar, stay close to this channel. The people who comment here with their own investment philosophy, the frameworks they are testing, the principles they are refining, make every conversation sharper and more honest. That kind of mutual accountability is rare. It is worth protecting.
In 2009, Buffett stood before students at Columbia Business School and made a specific offer. He would pay $100,000 for a 10% equity stake in their projected lifetime earnings. The arithmetic locked in immediately. If 10% is worth $100,000, the whole is worth $1 million. $1 million. Before a single career decision had been made. This was not flattery dressed up as finance. Buffett was applying the same valuation discipline he uses on every asset he has ever purchased. A human being generating income across a 40-year career is, by any rigorous accounting, a compounding instrument of enormous scale. The math simply demanded that number. That $1 million is the floor. It is the baseline, the plain, unimproved asset sitting on the balance sheet of your life right now, before any deliberate development has occurred. Buffett then raised the offer. For any student willing to genuinely master one specific skill, the 10% stake jumped from $100,000 to $150,000.
A single capability, deliberately refined, was worth an additional $500,000 in implied capital value, immediately. Not compounded over a decade, not earned through a second graduate degree. Immediately. The skill was communication. Specifically, the ability to stand in front of another human being, or a room full of them, and deliver an idea with clarity and conviction. That was the $500,000 premium. Not machine learning, not financial modeling. The oldest professional tool in existence. Now consider the wall of Buffett's office. He holds a degree from the University of Nebraska. He earned a master's in economics from Columbia University, the very institution where he was delivering this lecture. Walk into his office, and you will not find either diploma on display. What hangs on that wall is a certificate from a Dale Carnegie public speaking course, completed in 1951.
That is the only credential he chose to frame across a career that produced one of the greatest accumulations of private wealth in recorded history. He has said plainly that this course changed his life. As a young man, the fear of public speaking was not a minor inconvenience. It was a cage. The intellect was already there. The ideas were already forming. But without the ability to deliver them, none of it moved. His own description of the problem is precise and unsparing. If you can't communicate, it's like winking at a girl in the dark. Nothing happens. The insight exists. The value exists. But sealed inside a mind that cannot transmit it, the asset earns exactly zero return. Every idea you cannot articulate clearly is a unit of capital sitting idle. Every room where you stay quiet when you should speak is a transaction that never clears. The intellect without communication is a factory with no shipping dock, fully operational, permanently stalled.
Here is where most people's financial story diverges. They receive a diploma, and they stop. The degree goes on the wall. The books go on the shelf. The deliberate work of development ends precisely at the moment the formal structure that required it disappears. In corporate finance, this has a name. An asset that receives no ongoing capital expenditure, no maintenance, no upgrades, no reinvestment in its operational capacity, depreciates. The machinery rusts. The competitive advantage dissolves. The market moves on without it. Human capital follows the exact same law. A professional who stops learning is not standing still. They are falling behind in real, inflation-adjusted terms. The nominal salary may hold for a while. The market indispensability erodes quietly beneath it, year by year, until the gap becomes impossible to close. Two trajectories are available, and they begin from the same starting point, same baseline valuation, same credential, same morning.
What diverges is not talent,
And it is not opportunity. The first trajectory? Stop developing after graduation. Rely on the credential and watch the $500,000 asset slowly decay as the market advances around it. Stagnant real wages. Growing vulnerability. The moat fills in from the edges until there is nothing left to defend. The second? Treat self-education as a daily capital expenditure. Read about economic fundamentals. Refine the ability to communicate. Acquire skills that compound on each other. Widen the moat continuously so that when the cash flows materialize, they are protected by an advantage competitors cannot replicate. Both of these outcomes are available to the same person. What determines which path is taken is a single, repeated, daily decision about how to spend the next hour, made in private, with no audience and no immediate reward. Most people do not see this.
Not because they lack the intelligence to understand it, but because no one has ever shown them the math. They do not register the depreciation as it happens. They do not see the compounding they are forfeiting. The Dale Carnegie certificate on Buffett's wall looks like a decoration. It is actually the most consequential financial signal he has ever sent. You already hold the asset. The baseline is there. But right now, on your monthly bank statement, in the interest rate printed in small type at the bottom of the page, something is already compounding against you, and it is doing so at a rate the equity markets have never reliably beaten. Every investor on Earth is searching for the same thing, a place to put their money where inflation cannot reach it, where taxes cannot eat it, where no central bank can debase it. Most will never find it because they are looking in the wrong place.
At the 2022 Berkshire Hathaway annual meeting, Warren Buffett said something that should have stopped every investor cold. He did not talk about which stock to buy. He did not talk about which sector to favor. He talked about the enemy. Inflation, he said, swindles the bond investor. It swindles the person who keeps their cash under their mattress. It swindles almost everybody. Almost everybody. Think about what that word almost is carrying. It is the most important word in that sentence because it implies that somebody escapes, that there is a position, one specific position, that inflation simply cannot swindle. The question is, what is it? Gold, the oldest inflation hedge in human history. It is tangible. It is scarce. The option that feels safest. The option that feels most controlled. Inflation turns it into a slow-motion wealth tax. Every single year, the purchasing power of every dollar in your savings account declines. Guaranteed. Cash does not protect you from inflation. Cash delivers you directly to it. Equities, the strongest conventional answer, and historically, the right one, over long periods. But equities face margin compression when input costs rise. They face capital gains taxes on every dollar of realized appreciation, and they require you to trust systems entirely outside your control. The market will do what it will do. You are a passenger.
Then, there was Bitcoin, marketed aggressively as the ultimate inflation hedge, digital gold, a fixed supply asset in a world of infinite money printing. Charlie Munger, Buffett's partner of 6 decades, was asked directly whether he would buy Bitcoin as a hedge against rising prices. His answer was 2 words: just say no.
4 asset classes, 4 failures on the dimension that matters most. Gold does nothing. Cash destroys you. Equities tax you and ignore you. Crypto earns 2 words from the world's most disciplined investor. When Buffett was asked, directly, plainly, what the single best hedge against inflation is, he did not name an asset class. He named a behavior. The best thing you can do, he said, is to be exceptionally good at something. Sit with that for a moment. The man who has allocated capital more skillfully than any human being alive was asked how to protect against inflation. And he pointed at you, not at a ticker symbol, not at a commodity, at the skill sitting inside you, waiting to be developed. Here is the economic logic. When inflation rises, prices rise. That means the nominal value of what a skilled professional charges also rises.
A surgeon who earns $200,000 a year in a low inflation environment earns more in nominal terms when inflation is at 8%. The skill itself reprices automatically. No transaction required. No tax event triggered. The market adjusts the compensation without you having to sell a single share. But it goes further than repricing, because skill compounds internally. Every hour you spend mastering your craft makes the next hour of practice more productive. Every client you serve deepens your judgment. Every problem you solve expands your capability. The asset grows continuously, not by external market forces, but by your own deliberate action. And now, the single most powerful structural advantage of human capital over every other asset class. The best investment by far, Buffett stated, is anything that develops yourself. And it's not taxed at all. Not taxed at all.
Those 4 words represent the most significant return enhancement available to any individual investor on Earth. Think about what "not taxed at all" actually means in practice. When your equity portfolio grows, you pay capital gains tax on every dollar of realized profit. When your rental income arrives, you pay income tax. When your bond matures, you pay tax on the interest. Every external asset has a toll booth standing between you and your return. Human capital has none. The IRS cannot send you a bill for becoming a better communicator. The government cannot levy a charge against your improved judgment. No brokerage statement exists for the compounding value of your reputation. The return on developing yourself flows back to you, completely, permanently, without dilution. This is not a tax loophole. It is structural. It is permanent. It is available to every single person watching this.
There is one more dimension that separates human capital from every asset in a conventional portfolio. No government can seize it in a crisis. No creditor can attach a lien against it. No market panic can force a distressed liquidation. It is the only asset that remains with you completely, in every jurisdiction, under every economic condition, regardless of what the external world is doing. You cannot confiscate a mind. Gold offers a partial inflation hedge. It produces no yield. You hold it entirely at the mercy of a market you cannot influence. Cash guarantees negative real returns in any inflationary environment. Equities provide a long-term hedge, but every exit is taxed and every price is set without you. Human capital reprices automatically with inflation.
compounds internally without a taxable event, and develops at a rate controlled by exactly one person. On every single dimension, human capital wins.
The asset class that defeats every other asset class on inflation immunity, tax efficiency, and personal control is the one asset class that requires no brokerage account to access. Here is where discipline enters. Because this asset, unlike all the others, demands something the others do not. Gold does not require you to change your behavior. An index fund does not demand you become a better version of yourself. Human capital is the only asset that compounds only if you invest in it deliberately, consistently, and without interruption. It depreciates the moment you stop. This is why the framework insists on the daily reinvestment of time, not a quarterly contribution, not an annual review. Daily. The gap between the person who reads about their profession for 30 minutes every morning and the person who does not is invisible in week 1. It is noticeable in year 1. It is decisive in year 10. This is the foundation. But a foundation alone does not build the structure, because building it requires capital, and capital requires a balance sheet that is not bleeding. There is a force working against you right now, one that compounds just as relentlessly as skill does, and it is not the stock market. It is a number printed on your monthly statement. What happens when 20% interest meets 10% returns? The mathematics are not ambiguous, and they are not forgiving. There is a question sitting on your monthly statement right now. It doesn't look like a question. It looks like a number. But it is asking you something very important. Which side of the math do you want to be on? Credit card interest rates routinely run at 18 to 20% per year. That is not a fine print detail. That is the single most important number in your personal financial life. Warren Buffett put it without decoration. If I borrowed money at 18 or 20%, I'd be broke.
The man who built one of the greatest fortunes in history said that plainly. He did not hedge it. He did not qualify it. Now, consider what most people do. They hold $5,000 in a savings account or a brokerage account. They feel responsible. They feel like investors. And they are also carrying $5,000 in credit card debt at 20%. Here is the arithmetic. The S&P 500 has returned roughly 9 to 11% annually over its history. $5,000 invested earns at that rate. Meanwhile, $5,000 in debt at 20% also compounds against you at twice the speed. The net result? You end 5 years with a loss of $5,500. You tried to build wealth. The debt erased it, and then charged you for the attempt. Now, one the other scenario. You take that same $5,000 and eliminate the debt first. No investment, no brokerage account, just zero balance.
Over those same 5 years, the interest payments you no longer make represent a guaranteed, risk-free gain of $8,500 in retained capital. Buffett called it directly. It's going to be way better than any investment idea I've got. Not one of his ideas, not most of them, all of them. A guaranteed 20% return beats a probable 10% return every single time. So, why do intelligent people keep investing while carrying high-interest debt? Because the stock market feels like progress. Debt repayment feels like retreat. This is not a math problem. It is a psychology problem dressed in financial clothing. The S&P 500 does not care about your feelings. In 2008, Buffett made a $500,000 bet that a simple, low-cost index fund would outperform a collection of sophisticated hedge funds over 10 years. He was right. The index fund won. Complexity lost. Discipline won. The lesson was not that index funds are magical.
The lesson was that cost, patience, and consistency defeat cleverness. The same principle applies to debt. Consistency in elimination beats cleverness in allocation. Because the math of debt and investment only explains half of the long-term equation. The other half cannot be found on a balance sheet. Buffett has posed a question to students for decades. He calls it the classmate exercise. Imagine you could buy 10% of one of your classmates for the rest of their career. Who would you choose? Most people assume they would choose the highest grades, or the most natural talent, or the best connections. But when Buffett asks people to actually decide, the criteria shift completely. The qualities investors consistently select for: generosity, honesty, leadership, the willingness to give credit to others, the instinct to take responsibility rather than assign blame. Not IQ, not pedigree. Character.
Buffett distilled it into 3 traits: intelligence, energy, and integrity. And then he issued a warning that stops most people cold. If they don't have the last one, he said, don't even bother with the first 2. A brilliant person who cuts corners will eventually cut you. Someone with boundless drive and no moral compass will outrun consequences. Until they don't. But integrity, applied steadily over time, converts intelligence into trust and energy into compounding reputation. That chain is what separates a long career from a short one. And here is what most people never stop to calculate. What does it actually cost to compromise your integrity once? Not in dollars, in compound interest. Because reputation, once lost, does not recover at 9% annually. Buffett did not arrive at his philosophy from theory. He arrived at it from practice. As a teenager, he delivered 500,000 newspapers. He filed his first tax return at age 14.
He understood early that the habits installed in youth are the ones that compound over a lifetime. Over 99% of Warren Buffett's net worth was accumulated after his 65th birthday. 99%. Not because he discovered a secret late in life, but because he had spent 50 years building the asset base, the skills, the reputation, the integrity, the discipline that the compounding finally had room to express. This content is for educational purposes only and does not constitute financial advice. Your specific situation requires the guidance of a qualified financial professional. The arithmetic here is documented. The principles are sourced. The application is yours to make. The paperboy who delivered 500,000 papers and filed taxes at 14 did not become the world's most studied investor because he found a better stock.
He became that investor because for 60 years, he refused to borrow at 20%, refused to hire people without integrity, and refused to stop building the one asset no external force can reach. The 99% was not luck. It was the invoice for everything that came before it.